All right, guys, welcome back to another video. We are going to talk about the alternative minimum tax in this video. I'm going to give you a quick breakdown. Again, if this is your situation, then you want to work with a tax professional to make sure you get it right. I'm just going to explain what in the world it is and some of the basics about how it's calculated and some of the strategies around it, but definitely work with somebody on this, okay? So alternative minimum tax, or AMT, is a separate parallel income tax calculation. Okay, so we have the federal income tax brackets and that whole system that we've already discussed. AMT is parallel to that. It's different. It has different deductions, different exclusions from income, and some add backs of income that isn't typically taxed, but then is added back in. And they run a parallel calculation here. And the whole reason they did this is because they didn't want very, very wealthy people to, by pairing certain deductions and credits and types of income all together, to get out of paying at least a very bare minimum amount of tax. And so they wanted to make sure that they were paying their fair share, so to speak, or at least a very minimum amount, instead of just using the tax code to avoid taxes altogether, okay? Now, some of these situations don't just apply to the ultra wealthy, they do apply to regular, ordinary people, specifically in the case of incentive stock options. This is most common. And so they've made some allowances for that, but essentially they run parallel and then you pay the greater of the two. Okay, that's basically how it works. So here's the basic formula, okay? So you take your taxable income, and what you do is they're looking for the alternative minimum taxable income, so AMTI. They're looking for that by excluding some deductions and credits and then adding back other things as income that typically are not counted as income on the federal level. Some of these are the bargain element. When you exercise your incentive stock options, you pay this amount per share, the fair market value is this. This bargain element is not considered taxable income in the normal federal income tax calculation, but it can be considered income for AMT purposes. So we're not talking about selling. We're not talking about once you sell the stock, just when you exercise the stock and you get that bargain element, they can add that back in. And then sometimes some income that comes from using accelerated depreciation versus straight line depreciation. There's other special types of income that might be added back in, like special interest bonds or certain dividends or certain investment income. So there's a long list. I'm not going to go through it all now, but these are common ones that I see a lot with clients that I work with. So you get that income, okay, and it's going to look different again because you're taking out most of the deductions and then you're adding income into the equation that didn't exist before. So you have your taxable income in the federal income tax brackets, and alternative minimum tax brackets looks very different. The income numbers look different. So once you find your alternative minimum taxable income, what you do is you subtract out an exemption amount. So if you file single, it's $75,900. Married filing jointly, it's $118,100 for 2022. These numbers change periodically. So you take your alternative minimum taxable income and you subtract out this AMT exemption amount. So you don't have to pay tax on that amount. And this is to mainly help people that aren't ultra wealthy, but are like normal income earners, middle class income earners, from paying alternative minimum tax just because they have an odd situation here or there. Okay, that's why the exemption is so large. And then this phases out over time until you get to, if you file single, $539,900 of income. Married filing jointly is over $1 million of income. Okay, so it phases out. So really, people that are earning a lot of income, over 7 figures if they're married filing jointly, then they don't get that exemption. They just get the full brunt of the taxes. Okay, so then that gets your taxable income. Okay, minus the exemption amount. Then we can run the taxes based on the brackets. And there are only 2 brackets. Everything is taxed at 26%. And then once income exceeds $206,100, any amount above that is taxed at 28%. Okay, so there are 2 brackets compared to many brackets right over on the other side. So They run this calculation and they look at what is the tax bill that you owe according to AMT. Then they do the federal income tax calculation. They look at the total tax that you owe there. You will pay the greater amount of the two. So if you're using a lot of deductions and things like that over here, and so you're paying, let's say $20,000 in taxes, but based on the AMT amount, you should be paying $50,000, then you are going to pay $50,000. That is your minimum tax that you are paying. All right. So let's think about this in terms of incentive stock options. Let's say your income is like $150,000 on the regular federal income tax. But when you exercise options, there's a large bargain element. And let's say you exercise, I don't know, 10,000, 20,000 options. And based on the strike price and the fair market value, the bargain element is, $100,000 or $75,000 or something like that. That $75,000 is going to factor in as income for the AMT calculation. And so then you run the numbers, and based on having a really high bargain element in any given tax year, based on options exercised in that tax year, then you could have a larger AMT tax liability than federal income tax, and then you're paying the larger amount. That's like the most common scenario that I see with the clients I work with. Okay. One interesting thing to note, though, sometimes that's like a one-time thing, right? Or maybe it happens a couple years when you only have ISOs to exercise, but it's not ongoing. It's not like you've structured your income in a way to avoid taxes. It just so happens that you received ISOs and grants and that you exercised, and it's just the way the cards fell. So if you, for example, calculate AMT and you have to pay AMT in 1 year, but the next year you're back, you exercised all your options, you're just back to regular federal income tax brackets, they continue to run these parallel calculations every year. And the difference between what you would owe in AMT and federal income tax, let's say your federal income tax calculation, you're actually now paying more than AMT because you have normal tax years. Well, the difference between them, you can actually deduct from your taxes. So what you paid in AMT, let's say you paid $10,000 more in AMT in a given year. The next year, you don't pay AMT. Well, they're going to calculate what those amounts are, and you're able to carry forward the $10,000 of extra AMT tax that you paid in that year, carry it forward and deduct that against federal taxes. And you're able to carry that forward until you basically earn that money back. Okay, so they're going to give you a chance to earn it back for these kind of one-time or rare events that happen, like especially with incentive stock options. And so it's not like the money's gone forever, but it might take a couple of years for you to actually earn that back.
Strategy beats surprises.